All right, so good morning, everyone. Following the success of my first policy speech at Columbia University, I've called you together to help me prepare for a follow-up talk. So as you know, 4 weeks ago, the FOMC decided to continue policies announced at previous meetings. Therefore, our goal today is to analyze current economic conditions, to forecast future conditions, and to determine monetary policy options going forward. So with that said, Patrick, we'll start with you.
Sure, Governor Trullo.
Let's keep it informal, guys. Just call me Danny.
Okay, Governor. While growth was revised downward last week, the preliminary estimate of GDP is still a hopeful sign that the economy is staving off recession. Real GDP grew at a 2% annualized rate in the third quarter, which is still up from the very slow growth in the first half of the year. Growth was led mostly by consumption and non-residential fixed investment. Exports also grew despite concerns surrounding European sovereign debt. Now, I just want to remind all of you guys that this estimate is still subject to further revision, so we should also look at some monthly data.
Pat, I think we'd all agree that growth would have been more robust if it weren't for the especially disappointing housing market. Housing starts declined in October and are averaging only about a third of the level that we'd expect in a more normal recovery. Home prices have been up the past 2 or 3 months, but they're down nearly a third from their peak level that we saw in April 2006.
And in its efforts to stimulate housing demand, the FOMC has already acquired over $1 trillion of agency mortgage-backed securities. And going forward, I believe that both the Maturity Extension Program and the Agency MBS Reinvestment Program should provide further support to the housing market by putting additional downward pressure on mortgage interest rates.
Well, these policies should reduce spreads between mortgage-backed securities and treasuries. The good news is that since at least the beginning of the second round of LSAPs, longer-term interest rates have remained at low levels, and the open market desk has been successful in flattening the yield curve.
Housing is not the only weak spot in today's economy. The labor market continues to underwhelm as well. Last month, the economy added 80,000 jobs, with job growth in the private sector making up for the losses in the public sector. While the increases of the past few months have been revised upward, and household surveys show even greater employment gains, job growth overall has not been enough to reduce the unemployment rate, which remains at 9%. A broader measure of unemployment, the U6 number, also remains elevated, though it did fall a bit in October.
Given these high unemployment rates, it's only natural that the consumer is still remaining cautious. Growth in consumer spending is slowing relative to last year. Real disposable income did grow from September to October, but on a year-over-year basis, it has actually been declining each of the past 3 months.
I disagree slightly with your assessment of consumer spending, David. We know that retail sales were solid in September and October, and the series continues to grow at a respectable pace.
Yeah, but I'm not sure that spending growth will continue given recent stock market volatility. Additionally, there are new concerns in interbank lending markets, as indicated by the widening TED spread. The European Central Bank and Bank of England are preparing for possible sovereign debt default and any accompanying interbank lending problems by auctioning off liquidity to banks and making additional bond purchases.
Well, while the financial market outlook may be bleak, there is some good news in manufacturing. We know industrial production has been increasing since June 2009.
Although the forward-looking new orders component of the ISM index has recently been rebounding into expansionary territory, the index as a whole remains very low relative to earlier in the year.
All right, well, now I'll present some data. So both the CPI and the PCE price index remain near the upper bound of the FOMC's implicit inflation target, which in turn could complicate the justification for further monetary easing if needed. But now let's turn our attention to the future, always a much more interesting discussion. So my colleagues at the FOMC are now cutting the outlook for output growth and raising estimates for the unemployment rate. So although temporary factors from earlier in the year have subsided, it appears that there are still more persistent factors that are holding back the recovery.
Yes, Daniel, you're completely correct. Ken Rogoff and Carmen Reinhardt's breakthrough research reminds us that financial crises always have a devastating impact on economic recovery and future growth. After banking panics, bank lending contracts as financial institutions become more cautious and consumer and government spending slows as they attempt to pay off debts. This deleveraging and uncertainty will constrain economic growth.
A contraction in bank credit might help explain why investment is the only major component of GDP to still sit below its previous peak. While the rebound in business equipment and software spending has been encouraging, weaknesses in both commercial and residential real estate remain. In most recoveries, it's real estate that leads the way. However, today, despite historically low mortgage interest rates, the decline in housing demand has been so protracted that it has overpowered all of the powerful easing measures undertaken by the FOMC.
And in fact, at his recent news conference, Chairman Bernanke argued that tight credit standards have in fact blunted the effectiveness of monetary policy. So would any of you here agree with the chairman that the traditional transmission channels of monetary policy are clogged?
Daniel, I wouldn't argue that. We know that monetary policy works with a lag. Our maturity extension program should help reduce yields on longer-term treasuries, which will in turn lower mortgage rates and hopefully encourage more mortgage refinancing.
Well, to me, both housing and consumer spending are dependent on the prospects for employment and income growth. While jobless claims are on a downward trend, they're still elevated relative to pre-crisis levels.
But Pat, the reality is that a very large share of the unemployed has been jobless for more than half a year. Their skills deteriorate as they remain out of work, and with every additional week of joblessness, their future employment prospects diminish significantly.
And I think it'll be difficult for the labor market to gain traction with the ongoing fiscal drag. We all know that the layoffs of teachers, police officers, and other government employees will not help the labor market.
But hold on a second, Daniel. The Fed can address labor market weakness by being creative. We've seen some recovery in private payrolls, mainly by small and medium-sized businesses. So we must make sure that community banks and credit unions have sufficient liquidity in order to lend to smaller firms and foster further job growth by them.
That I agree with, Pat, but the job gains that you mentioned have been completely inadequate. This dismal labor market has done little to improve consumer spirits. Consumer sentiment remains weak and is likely to remain so as long as unemployment stays high. And if consumer spending remains sluggish, then firms aren't going to hire. The economy needs our help in the most desperate way.
David, you're definitely being too pessimistic. The two major impediments to consumption in the spring, oil and commodity price increases, have mostly stopped. Going forward, we can be somewhat optimistic about prices. Short-term survey measures of inflation expectations are actually decreasing from previous highs. Longer-term measures remain relatively well-anchored. TIPS break-even spreads have been declining as well, indicating a market-based perception of disinflation over the medium term.
Another source of optimism is that the credit crunch, which has been hindering spending, is easing. On net, banks are still loosening credit standards for C&I loans. Bank credit overall has been expanding. Another way to see this is the recent expansion of M2.
And let's not neglect the risks of recovery. We all know that the Eurozone is currently struggling with the debt loads of peripheral countries. Our financial system is not unexposed to European sovereign debt, and therefore a default by one of the Eurozone members would likely cause some significant financial market instability.
Yes, Daniel, we all know that financial instability would definitely be troubling. But over the past few years, the Fed has demonstrated skill in mitigating financial crises by acting as a lender of last resort and by making dollar liquidity swaps to foreign central banks. Another source of anxiety would be the decline in U.S. exports if European countries fall into recession and if the dollar appreciates due to a flight to safety.
And the housing market has to be considered another source of risk. I recently read a report by the realty tracking firm Zillow that 29% of homeowners with a mortgage currently owe more than their home is worth.
But there has been some improvement in housing. Take, for instance, the home inventory to sales ratio, which has recently been declining, hopefully to more normal levels.
I don't know about that, William. The series you refer to is composed only of new homes, a very small part of the total housing market. One risk I am sure of, though, is the uncertainty surrounding fiscal policy. In this heated political climate, I don't see how Congress is going to find the proper balance between short-term stimulus and long-term debt reduction.
And guys, I'm also very concerned about political encroachment into the Fed's independence. In my view, critics of the Fed are merely unhinging the central bank's credibility as an inflation fighter and undermining policy efforts pursuing maximum employment under price stability.
I'm enjoying the discussion, everyone, but unfortunately, I'm short on time. So let's now discuss additional policy options, such as providing additional forward guidance, cutting the interest on reserves, or even perhaps a new round of LSAPs.
First, Daniel, I'd like to remind everybody about the huge downward revision from earlier this summer to GDP levels over the past few years. Had we known then how bad the recession really was, our past monetary policy stimulus programs would have been much larger. We didn't do enough then. We have to do more now.
Whoa, wait a minute, David. Monetary policy should be forward-looking, not backward-looking. President Fisher of the Dallas Fed argues that central banks are doing too much. I tend to agree. We've already done what's important. That is, lowering the federal funds rate to nearly zero and expanding our balance sheet. The marginal benefit of additional stimulus is outweighed by the added inflation risk. Moreover, we're in a problem of creating a moral hazard problem. Central bank activism allows those in charge of fiscal policy to delay making decisions on taxes and spending.
Come on, guys. Of course markets could use reassurance on fiscal policy, but we here in this room need to remain focused on monetary policy. We need to achieve our goal of full employment. But what is full employment right now? A huge concern of mine is the recent increase in structural unemployment, and monetary stimulus is quite frankly powerless against this.
Also, further easing, especially another round of large-scale asset purchases, could merely increase commodity price inflation, as many in the public seem to think that's all the second round of LSAPs did. But what else did it do? Sure, mortgage rates remain near all-time lows, but the response of home buyers continues to be muted. Yes, corporate borrowing costs have shrunk, but business spending still remains weak. And yes, there was a stock market rally, but consumer confidence experienced only a temporary boost. As such, I cannot support more purchases because of the ineffectiveness of the second round of bond purchases.
Look, Pat, what you just said exemplifies the fact that today traditional monetary policy channels are obstructed. These are extraordinary times, and the recovery is very weak right now. We need to let everyone know that the Fed is ready and willing to act. Let's actually spend some of our hard-won inflation-fighting credibility. The FOMC should aim for higher inflation in the short run, perhaps by instituting a nominal GDP targeting framework. More inflation would lessen the real indebtedness of both the public and private sectors, allowing them to finally start spending again. Inflation would also lower real interest rates and help to grease the wheels of the labor market, allowing for gains in both business investment and hiring.
And along similar lines, President Evans of the Chicago Fed has proposed committing the Fed funds rate to low levels until the unemployment rate falls to 7.5%, and as long as the outlook for core inflation remains below 3%.
But guys, we don't want to unanchor inflation expectations. And I get uncomfortable when even headline inflation runs above 2%, which everyone regards as our implicit inflation target.
But Michael, shouldn't 2% be an average rate of inflation? That most people treat it as a ceiling is misguided in my opinion. Inflation expectations of firms are well contained, according to the Atlanta Fed's Sticky Price CPI, a measure of the goods and services whose prices are changing frequently. Furthermore, wages are increasing at a very slow rate, showing little cost pressure on firms to raise prices.
Let's not forget Reinhardt and Rogoff, however. Financial crises invariably lead to slower growth for an extended period of time. In part, this has led the CBO to lower its estimates of potential GDP. Thus, the output gap now may be smaller than what people previously have estimated, leading to little need for further monetary policy accommodation.
But there's still slack in the economy. It's not equal to zero, Michael. We can address this by being a little creative. Despite the huge buildup in excess reserves, bank credit remains tight. We should then consider lowering the interest rate paid on reserves. Essentially, by paying 25 basis points to banks, we are subsidizing them to hold reserves and not lend.
Pat, we don't want short-term rates to get too low, which could damage money markets. Money market mutual funds and other unconventional intermediaries play an important role in shadow banking. They provide funding to commercial paper and other integral markets.
But lowering interest on reserves would largely be symbolic. The economy needs real stimulus right now. The current level of unemployment and the outlook for unemployment is unacceptable. We can fix this by perhaps instituting an unconventional round of large-scale asset purchases. The FOMC should purchase mostly agency debt, mortgage-backed securities, and even some private sector securities. After all, the first round of purchases, which was composed mostly of MBS, has garnered nearly unanimous praise.
Come on, David. Your proposal is way too radical. A more reasonable proposal would be to provide forward guidance over the future path of the balance sheet.
All right, great discussion, everyone. So now, here's what I'm going to recommend. I feel that a conditional balance sheet commitment can get the votes on the FOMC and be effective. So let's tell the markets that the FOMC does not foresee that it will shrink its balance sheet until mid-2013, like we've done for the Fed funds rate. Ideally, I'd also like to see additional purchases of agency mortgage-backed securities. I do believe that Chairman Bernanke would like to keep a third round of LSAPs up his sleeve, and I'll certainly work with him to guide the economy towards maximum employment in the context of price stability. Once again, thank you for your input, everyone.
Perfect, thank you. You hit the time exactly.
Sure. Well, thanks. That was a lively discussion, and you covered a lot of ground. And in particular, at right towards the end of your discussion, you got into some discussion of unconventional tools, of the tools available to the Fed at the zero lower bound for its short-term interest rate, normal short-term interest rate tool. So I want to give you a chance now to expand a little bit on that discussion. I'd like you to give me as full a description as you can of the set of tools available to the Fed when its short-term interest rate target is basically at the zero lower bound. What are the benefits of some of those alternative tools, and what are the drawbacks of some of those alternative tools, and including sort of a description of the mechanism through which these tools should work to provide stimulus to the economy.
Okay, so I'll begin by discussing one of the, I guess, most powerful tools, or a very powerful tool that the Fed has, and that's forward guidance. That's one thing that the Fed has learned, at least in recent history, how important it is to, or how valuable forward guidance can be, particularly when we're at the zero lower bound. And we've seen it by, for example, in the press release from the August meeting, the FOMC announced that it was expecting to keep the Fed funds rate low until mid-2013, according to forecasts and everything. And the mechanism through which we expect this to have an effect on the real economy is through the term structure of interest rates. We would expect markets then have reduced this would reduce risk premium, and therefore then begin to lower longer-term rates.
A drawback to this stimulative forward guidance is that it could unanchor inflation expectations. And we know that when inflation expectations become unanchored, it's very costly to bring them back down in terms of the effect of increasing unemployment. And so why don't we move on to another possible unconventional tool, one that is still very potent potentially, which is large-scale asset purchases. The Fed presumably could purchase more longer-term treasuries or even purchase agency-backed, mortgage-backed securities, which would be credit easing, because the Fed would be targeting a certain sector of the economy. Some benefits of this would be large-scale asset purchases would lower longer-term real interest rates, which have a direct effect on consumption and investment activity, which would grow the economy.
And you're saying longer-term securities, right? And so the mechanism through which we would expect that to happen is what economists and investors call the portfolio balance effect. But now I'll provide a con to this tool. This could complicate the exit strategy even further. One thing that has come up, even though it's not being discussed right now, because we're not really, the exit strategy is not seen as something that's going to happen very soon, but nonetheless, monetary policy has to be forward-looking. So when the time comes, if the portfolio now consists of mostly longer-term treasuries, there is some added risk to the exit strategy.
And another drawback to large-scale asset purchases is that it could disrupt market functioning, especially if the Fed purchases more longer-term treasuries. This could disrupt the functioning of the treasury market, which is very important to financial stability.
I kind of follow up just a little bit. The Fed has done some of both of these things over the last couple of years. Can you talk a little bit about how we should go about assessing the effectiveness of the things we've done already in this regard, and in your sense of what those effects have been and how they've shown up?
Well, as far as looking at how LSAPs affect the real economy, the yield curve is a very useful sort of data series that you can look at. And we've seen that the first round of LSAPs did, in fact, reduce yields on treasuries. The second round had less of an effect, certainly. And we've seen with the maturity extension program, hopefully we'll see sort of this flattening of the yield curve, these longer-term rates coming down.
Are you familiar with any quantitative estimates of how much the first round of LSAPs affected long-term
There was actually
rates?
a paper published, written by Brian Sack and two of his colleagues over at the New York Fed, about estimating the effects of the large-scale asset purchases. All right, so now if my mind serves me, Justice, what was the estimated effects, about the equivalent of a reduction in the Fed funds rate of about what, was it 100 basis points or something?
Well, the maturity extension program, which was a smaller program than the second round of LSAPs, was deemed to have a larger effect on reducing longer-term interest rates because they were focused more along the back end of the yield curve.
Depending on how you look at it, too. One way to look at it is through 10-year equivalents. Since this is through the portfolio balance effect, you're expecting to have to impact eventually your target variables by reducing the amount of duration risk in the market. So if you're looking at the 10-year equivalents, actually looking at the second round of LSAPs and the maturity extension program is actually comparable in size.
Thank you.
Thank you.
You talked a little bit about some Fed officials who have spoken about inflation and unemployment targets and the dual mandate. So my question is, should the Federal Reserve set a specific target for inflation and or unemployment? And if those targets are set explicitly, then how should the Federal Reserve react as results move away from those targets?
I'm sorry, Governor Dugal. What was the last part? How should the Fed react?
How should the Fed react to the extent that we're missing those targets in either direction?
Well, I do think that the Federal Reserve does set targets in their projections. They actually have projections for inflation and also unemployment. And those are projections that the participants feel under their ideal monetary policies, what levels would look like a few years out. As far as recently, there's been talk on a reaction mechanism on how actually the Federal Reserve would intercede if a certain criteria were met.
And just to be clear, these are implicit targets, in particular the implicit inflation target. And I believe you're referring more to
what's the difference between a target and a projection?
Well, we know for non-unemployment, for inflation, it's 2% in the long run.
Governor, I think you were talking about maybe Charles Evans' proposal to, keep the federal funds rate low until the unemployment rate falls to 7.5%, as long as the outlook for core inflation stays below 3%. And one of the ways that this could work is that if one would describe the economy as being in a liquidity trap, such a commitment would serve to strengthen the Fed's credibility in that it's going to keep the federal funds rate low until mid-2013, and perhaps lead market participants to believe that interest rates can go a little further downward, which would reduce real interest rates and be stimulative to investment and consumer durable purchases.
Okay, but to tie you down a little bit, do you think the Fed should set, first of all, a target for inflation, an explicit rather than implicit target for inflation? And if so, do you think, given our dual mandate, that we should also set a target for unemployment?
Well, at the last FOMC meeting, if you look at the meeting minutes, the participants were discussing attempting to set an explicit inflation target, but some participants felt that if we do that, we would be giving more weight to price stability as opposed to full employment, as opposed to the dual mandate of full employment. And obviously, the Evans line is that we should, try to tackle unemployment first because it's higher. It's more than 3% away from its natural rate. But others have argued that if we do, that the U.S. might be in a period of relatively high unemployment, sort of like Europe, and if we were to continue to tie stimulus to unemployment results, we might overstimulate the economy. So it's very dangerous sort of to err on either side, though central banks have been proven to be more effective when they, as one would quote it, act and talk like an inflation nutter at times.
Okay.
But with that said, though, most central banks around the world do have a price level targeting, but the Fed could use price or inflation level targeting as a guidance mechanism to the public. But as my colleague said, that this could put more weight on the inflation side rather than the employment side of the dual mandate.
Just to touch very briefly on why I see something wrong with announcing a target for the unemployment rate is the following. Monetary policy is not the only determinant of unemployment. There's other things that influence the unemployment rate. The Fed has more control over, or at least has more influence over inflation, not as much that this doesn't happen in unemployment. So announcing a target for unemployment might not be a wise decision, because then you might be putting yourself at risk If you're not meeting your target, your credibility is at risk.
Unemployment does depend on fiscal policy and unemployment benefits and all these other things. But one merit I do see to the Fed's clarifying of the Fed could clarify their longer-term goals for monetary policy, which I think there is merit, and that would give market participants, households, and consumers more of an insight into the Fed's longer-term goals.
Thank you. Sir?
So in your presentation, you touched on the crisis in Europe. So I'd like to invite you to talk a little bit more about this. Specifically, I'd like you to address it in two stages. First of all, what do you see as the nature of the crisis in Europe? And secondly, what are the potential implications for the U.S.?
I think I'd like to start maybe on the easier end of the question. What are the effects on the U.S.? And we've seen that the effects will probably be twofold. There'll definitely be an effect on our exports, our component of GDP, net exports. And there will probably be some global financial instability as a result of those institutions breaking down.
The nature of the crisis in Europe is very severe, to put it plainly. Italian, Portuguese, Irish, and other countries' 10-year yields are all above 7%, which is regarded by the markets as almost a default level type of yield. And this could have, if Europe does go into a recession, and as some people have said, it is already in a mild recession, if it does in fact go into recession, it could have severe implications, as we said in our presentation, severe global financial instability, because this could lower Asia's exports to Europe, and Asia 50% of Asia's exports, or China's exports, is to Europe. And if China slows down, then it affects everybody. So,
and 1/5 of U.S. exports go to Europe. So certainly, if Europe falls into recession, that would have negative effects on our economy. But I think the nature of the crisis is that obviously there was a financial crisis, a worldwide financial crisis, and there was a severe global recession. So when there's a recession, government expenditures decrease. Government expenditures increase due to unemployment benefits increasing, but government revenue decreases due to fewer people having jobs and paying income taxes. And Europe already had some fiscal problems, so this was exacerbated by the severe global recession.
And to just touch on, to emphasize at least a point that answers the second part of your question, the potential impacts. One thing that we have learned is just how increasingly interconnected the financial system is. We've learned, for example, with Lehman Brothers, the failure of Lehman Brothers, how this pretty much just affected the entire financial system. So we should not be expecting anything else from a country in Europe defaulting on its debt. So
More financial instability could serve to tighten lending standards, and credit is really the lifeblood of a growing economy. So we really can't afford for credit standards to become even tighter. They're very tight today, and it's difficult for households and firms to borrow to invest, which would be an important thing for growth for us.
And then just to finalize, confidence is very important for the recovery. There needs to be confidence that a recovery is taking hold. If something were to happen in Europe, if Greece were to default Italy, this would be a huge blow to confidence. And therefore, what my colleague just said, right, we would expect then credit standards to continue to tighten and things like that.
Especially a disorderly default would be very, very destabilizing.
So if I can just ask one follow-up on that, then is it, you've talked at some length on the effects of the crisis, the importance of Europe for exports and the financial interconnections. I just want to invite you to just elaborate a little bit more on the discussion of the nature of the crisis. You obviously mentioned the high yields in certain of the European countries. What is your sense of what the underlying problem, or problems plural, are?
I think it's important
First, very quickly, the monetary policy is centralized. Fiscal policies are not. Each country has its own fiscal policy, but yet we have the ECB running a centralized monetary policy. This is a problem. This is one of the problems in the.
And because fiscal policy is not centralized, it has become difficult for governments in Europe to bring down their debt problems because they cannot effectively collaborate like they do on monetary policy.